Hi, a very good morning to everyone. Benjamin here, your financials and offshore analyst. Right, today will be quite a short and sweet session for our weekly webinar. So in summary for the agendas for today, first up, we'll be giving some advice to small cap investors whereby we think that small caps have had a good run, right, but there's still room to go for small caps. And then next up, we'll feature a short piece on Sarine Technologies as we think that there is another angle to this solid company, and then a couple of downgrades on some of the US stocks after some strong price performances. Then next up, we'll give you our take on the week ahead. Right? So beginning our first part on the small caps, right? So from what we understand, right, there are many of our clients who love small cap stocks, right? Particularly the penny stocks. All right. So if you are a client or you have clients who tend to invest in small caps, right? We want to advise you that small caps do trade very differently from the large caps. So we look at the chart over here, all right? The STI, right, is a large cap index, right? Consists of 30 of Singapore's SGX largest stocks. So combined together, they constitute about 75% of the market value of all the equities listed on SGX, which is about 780 stocks, right, on SGX itself. So in comparison, right, the small caps forms around 8% of the total market value, right, in Singapore, right? And then another thing interesting to note is that large caps in Singapore are about half as volatile as all the other stocks on the SGX. So presumably investors are usually drawn to the high volatility with regards to the penny stocks. And of course, the potential to beat a high return from this penny stocks volatility. Right. Moving on. All right. Over the last 2 years, half of all the small and mid caps have outperformed the STI. All right. Comparatively with the STI, only about 12 out of 30 of the stocks on the STI have outperformed, primarily because the three banks did particularly well over the last 2 years, about 20-25% return over the last 2 years. All right. Another thing is that the price movement of the large caps are responsible for about 55.5% of the price movement in small caps. This means that the remaining amount of 44.5% of the price movement in small caps are largely due to the individual stock-specific reasons based on our regression. Right. So if you take a look at this over here, right, the previous data that we were talking about in the last couple of slides were pertaining to 2 and 10-year periods. However, if you look at this, which is over a 12-week period for the last decade or so, all right, small caps tend to outperform for short periods of time, which is denoted by the blue color bars over here. All right, so the small caps outperform the STI about 1/3 of the time. All right. One can also notice the scale of the small caps outperformance, right, which is on the right hand side over here, and also the blue bars, right. So the FTSE small cap index, when it outperforms, is usually more than 10 percentage points higher than the STI. All right. So another thing is that when the small caps outperform, all right, it tends to be really big. So again, more than 10% in comparison to the STI. All right. Next up. All right, we can see that the small caps have not performed very well compared to the large cap over the last year, right, which is over here. All right. However, this represents only a minor sell-off in the major uptrend that we have observed over the last 2 years over here. All right, and over the past 15 years, there were about 5 major sell-off in small caps. So 4 out of 5 of these events were largely categorized by the small caps running ahead of the large caps. So how we arbitrarily try to measure this outperformance is we took a ratio out of the FTSE small cap index divided by the STI, which gives us a coefficient. All right, so both are market cap weighted indices. So this arbitrary ratio over here, right, it sort of represents the relative outperformance, right, as well as the sort of an indirect relative valuation. So but what we observe, 4 out of the 5 sell-offs that we have seen, all right, is characterized by this coefficient reaching a 0.3 ratio. All right, so this is not a really sophisticated quantitative analysis, but roughly a quick and dirty way, but to give you guys a big picture of where the small caps are at now. Right, so the current ratio is about at 0.26, right, over here. All right, it's approaching 0.3. All right, the last time the ratio reached close to 0.3, which is 0.297, was in October 2014 during the penny stock saga. So that preceded the current minor sell-off. Right, so just remember that at 0.26 now, we're still about 15% away from 0.3. All right. So in the end, it's very difficult to time a small cap rally and selling out to avoid a drawdown, which means extended periods of significant small cap outperform before the sell-off happens, right? So that's roughly for the small cap sector. So I'll move on to our quick take on Sarine Technologies. So if you guys have been following this counter, which some of you should be quite familiar with, right, over the third quarter and fourth quarter, the results were a little soft, largely due to the reasons that we have highlighted in the previous quarter, which were due to some pressures in the diamond market industry, as well as tightening credit situation in India. Right, so the sell-off that we saw towards the end of December was not due to the fundamentals within the company, or neither was it due to the industry issues. Right, so the sales was largely due to a large investor holding about 1 million plus shares who wanted to sell off close off his position and take profit before the 31st of December. So subsequently after that, I think the market jumped in, and you can see that the price has recovered quite a lot over the last 1 to 2 months. All right. So just a quick run through on some of the financials over the last 5 years. As you can see, the revenue has almost doubled over the last 5 years. All right. So the Galaxy system is the one that they introduced back in 2009. All right, and he has grown exponentially, and currently there are about 190 odd machines that are deployed worldwide. All right, okay, so largely in India. All right, so this is the one that's driving the gross profit margins higher, as well as recurring revenue increasing substantially as well. Now it's above 35% since the time of introduction. So previously, the machines were sold more on a capex basis for their customers. Now, the expenditure from the customers is more on an opex basis. Right, so as you can see, net profit is being driven much higher as well. So currently, the GP margins for FY 2014, right, is around close to 70%, right, an improvement from about 65%, slightly below 65% back in 2010. Okay. So these are some of the key points that we like to highlight. First of all, Sarine has pricing power, right? Number one, that is due to them being a monopoly for the planning and grading equipment for the diamond manufacturers. So the current market share is about slightly higher than 70%, right? So this includes India and other regions as well. Right, the next up is the Galaxy machines. These are the one that maps the inclusions for diamonds, which determines the clarity of a diamond. So currently there's no viable competition for it as well. The Russian supposed competitor, which was competing for a higher range of the market, has not have any commercialization plans yet, and the India competitor has dropped out of creating a viable machine. And then currently there's another India and Israeli competitor who wants to come up with something similar as well. But again, those are just prototypes, and there's no plans to commercialize it yet. Right? So at the same time, if you look at the Galaxy machines, currently the market penetration is already about 50%, right, because of Sarine Technologies. So increasingly, if other competitors do not release a viable product for the manufacturers, Sarine is going to close and then eat up more market share and make it harder for other competitors to enter this industry. All right, next up, there was a little bit of situation in the diamond industry. First up, on the rough diamond side, De Beers was pushing up the rough diamond pricing, combining with an overload of inventory. Right, this was largely due to on the certification lab side, which is like the GIA side. Right, there was a lot of hold up of inventory over there, and when they reduced the lead time on certifying diamonds, there was a flood of polished diamond back to the market. So as a result of that, the diamond polishers were sort of forced to sell off the polished diamonds at a discounted price of 10 to 15%, right, to reduce the inventory, right, to sort of ease off their credit situation as well. So because of that, your polished diamonds, the prices come down, right, rough diamond prices are pushed up, the spread is compressed. As a result of that, the margins are also decreased. Right, so this reduces the incentive to increase manufacturing output. Right, but because of them ordering less diamonds, we expect De Beers going forward for the next couple of site holdings, which is an event to buy diamonds, right, to reduce their price, rough diamond pricing. Right, once the rough diamond pricing is reduced, all right, that's where the supply and demand and prices will start to rebalance. All right, so when that happens, that will bring back manufacturing activity of the diamond manufacturers. Okay, so the situation is we expect it to turn around sometime probably late in the second quarter of 2015. Right, so by the second half of this year, this should turn around. So currently there's a little bit of price weakness for Sarine Technologies due to this situation, and I think that the company itself is still fundamentally very solid, debt-free, superior margins, unique technology. So this represents a really good time to invest in this gem. The next up will be them having a couple of new launches which we believe will unlock their next growth stage. So previously we talked about the light and the loop technology, which is more of an imaging technology for diamonds, and that is targeted towards a different part of the diamond value chain, which is the polished diamond end. Right, so usually the earlier segments which are this, they dealt with rough diamonds. So for the new imaging tech is targeting the polished diamonds. So they're going to bundle both these products together with the new Sarine profile, which I'll show you guys how it looks like in a bit. Right, so this essentially will be targeting to take out the middleman for diamond trading. So there's a huge market over here for this. Right, and then the next one will be when Sarine originally started as a company, the technology was used for the similarly like planning and cutting of non-diamond gemstones. So they are going to reintroduce a new technology to penetrate this segment again. Right, so the markets that we're looking at is Thailand as well as another part of India, which is Jaipur, slightly up from New Delhi. Alright, so this one will be commercialized in 2016 probably, so we are awaiting more clarity on this. Similarly for this, this will be expected to have material revenue contribution, i.e. more than 5% for 2015. Right, so previously for these two imaging tech, the contribution was less than 1%. So expectedly when they bundle together and it takes off, it will be contributing more than 5% for this year. So in terms of the pricing wise, we'll be finding out that within this quarter, after they announce after the Hong Kong trade show. Alright. So if we take a look at the bottom over here, this is how the loop looks like. Right, it's a 3D imaging tech. Alright, followed by this is the Sarine light. Alright, so it measures the light performance of a diamond. So combining these two together, they're going to come out with a Sarine profile over here. Right, so this will be more of an inventory logging as well as a sales and trading tool for the diamond traders as well as the diamond manufacturers. So you see combined together with a GIA cert, it gives you almost a complete picture of how the diamond is like before you make a purchase, right? But of course, that is not for us retailers to be using, right? This is more for the trader side. Right, so we look at our scenario analysis over here. Our base case is 330 target price. So let's look at the bull case over here. All right, if you look at only about a 30% penetration for the polished end of the diamond market. All right, we're looking at about 350, right, in terms of the fair value, and we are being very conservative over here by our scenario analysis of 30% market penetration. Right, if you look at their Galaxy technology, over 5 years, they have managed to achieve 50% penetration. Right, so being conservative at about 30% penetration and conservative pricing for their technology, we're looking at about 350. So easily 30% of upside from current price today. Okay. So after that, okay, we have a couple of ideas from the past week, right? So it's a couple of take profit from FNF Ventures, Chip Insing and Priceline. So the share price performance has been really strong. Alright, so we have a couple of calls from this from our research notes last week. Alright, we have a couple of results from the previous week as well, and some non-rated notes which you guys can refer to from our previous week's research reports. Right, so to sum up, we have a schedule of what's going to happen the week ahead. So this week is going to be a pretty quiet week in terms of earnings and economics. So the key announcements are on Wednesday, right, for the beach book from the Fed Reserve, all right, as well as the EIA stats on the oil production. So this will likely drive or affect the oil prices right over here. Okay, so with that, I'll wrap up the presentation for today and open the floor to any questions that you guys might have. Hi, Benjamin here. I have a couple of questions on the line. All right, so first up, I'll answer the one on Sarine first since it's pertaining to today's presentation. Right, so someone is asking who are Sarine's peer competitors. So in terms of we look at the manufacturing sector, there is quite split between a couple of players. So I would just say that their main competitor is number one, this guy called Octonus, who's from Russia. All right, so the Russia side, they are targeting more towards the high end of the market. So Sarine is more the mid end, which is what the Indian manufacturers are looking at. So the Russian tech is mostly for the diamond polishers in Belgium, some of the diamond polishers in Belgium, and some of the guys in Russia. So the problem with the Russian technology is that although is I would say slightly better, right? But the thing is the pricing is much higher, and the user friendliness of their equipment is something that the India guys do not like to use. So and that's why their market share is probably around 10% for the Russian guys, and then there are a couple of small ones. There are US players and a couple of smaller for India players as well. But largely so, the bulk of it, 70+% is taken up by Sarine, right? And next up, we have a question on outlook on the oil and gas sector. Currently, we are still quite bearish on the oil and gas sector. Number one, we have to look at the crude oil stockpile in the US is still increasing. All right, so but we expect going forward over the next few months, right, the production levels in the US will start coming down. Right, so from what we have observed, both on the onshore and offshore, the rig counts have been starting to come down. Right, the onshore side largely because the US land drillers have been taking rigs off production, and then for the offshore side, right, so the big drillers like Transocean, Seadrill, right, Ensco, they have been taking off their offshore drilling rigs. So largely on the deep water side, they've been retiring quite a number of rigs and impairing whatever that's left right? So some of the rigs are quite old, right? So they've been taking these off the market as they are unable to secure new contracts. And then for the newer ones, right, some of the contracts are receiving a much lower day rate. So we can expect more supply to be taken off the market, right? So this will help to balance the oil production levels going forward, right? And then if you look at the Singapore side, right, there's quite, we're not too positive on both Keppel and Sarine, right? So Sarine, about half of their order book is exposed to Petrobras. So Petrobras is undergoing some financial scandal now, if you have been monitoring the situation. And then those Seti Brazil, which is the offspring from Petrobras, which has ordered about 6 to 7 drill ships from Sarine, has just cancelled a number of drill ships from another manufacturer, another yard over there in Brazil. So there's a bit of an issue in terms of payment, right, for Petrobras. All right, so that's why we are a bit negative on Sarine. All right, so if we go more downstream wise, we look at the services sector. All right, for the oil services sector, there's a bit of a knee-jerk reaction from the major oil majors. So what they are doing now is that they do expect the oil sector to turn around in 12 to 18 months, right? But currently at this point of time, because they are the big bullies, right, they're going in and then they are locking in charter rates at a discounted rate. So players like Ezion, Pacific Radiance will be taking a little bit of hit in terms of the day rates for their offshore assets, right? So because these guys, they want to lock in their charter rates at a lower rate now, considering the market situation is down, right? So with that, that's roughly it for the oil and gas sector, right?
Hi, this is Sam, and there's a question on why is TriDarts doing so badly as compared to ASEAN. Currently, I still look into like TriDarts, and to me, it's hard to compare TriDarts with ASEAN because they are in two separate businesses. TriDarts builds lift boats, while ASEAN charters those heavy vessels and mostly like vessels and other lift boats as well. So they are like in two different businesses. TriDarts, it has already broken its lows right now, and to us or to me, I find it quite cheap. And revenue-wise has been able to come above the expectation for last quarter. I might be meeting them shortly to give an update on TriDarts and in near future as well.
Hi, Benjamin here again. I have a question on what's the effect on Sarine with some of the diamond polishing business moving from India to China. But there is a bit of movement in terms of the manufacturing side, which is the diamond polishing, as you have mentioned, going to China. But if you look at the total volume-wise, okay, 90% of the diamond weight, right, that's being produced worldwide is coming from India. By market value-wise, about 75% is from India. So it's minimal in terms of volume-wise of movement from India to China. So if we look at the industry dynamics by itself, all right, of course, usually this kind of thin margin polishing activity will always move to a location where its labor cost is cheap. So of course, India is one of the cheapest one. That's where over the last 30 years, we have seen manufacturing activity move from Belgium, from Israel to India, right? So similarly now, they are finding areas like South Africa, China to move their manufacturing activity to. But we must understand that over the last 20 years or so, right, much of the manufacturing activity, because it's been going in India, and there's a lot of government initiatives to support the polishing activity in India, right? There's been a lot of training in terms of skill sets with regards to diamond polishing in India. So it's hard to rebuild a huge industry over there with an appropriate skill set to polish diamonds, right? So a lot of it in India, those are the largest players that we see in the polishing industry, owned by the various rich Indian families, which are also dealing with other gemstones other than diamonds, right? And then I have a question on there's a 20 cents minimum trading on the main board stocks as of from today, and what's the impact on trading these penny stocks from now. Alright, so SGX has implemented a minimum trading price of 20 cents. Alright, so but for this implementation, they are giving a 3-year period for the companies to comply with this. So after that, after these 3 years, right, if companies do not comply with the minimum trading price of 20 cents, they will be removed from the main board, or the companies can elect to move to the Catalyst Trading Board. Alright, in terms of the fee waiver wise from SGX for share consolidation, alright, that will be waived for the next 2 years. So what we'll be seeing going forward is probably companies taking some form of corporate action to do share consolidation, right? Especially, I think there are about, on the SGX itself, about 170 odd companies are trading below 20 cents as of today, right?
Hi, this is Lindsay, your macroeconomist covering China market. So someone asked what is the outlook of Shanghai and Hong Kong market in the next 3 months. So as we know that on last Saturday, PBOC actually cut their benchmark interest rate for the lending rate as well as for the deposit rates by 25 basis points. This is their second interest rate cuts following the November's last year's. With this, we actually expect that China yuan would continue to weaken, and that should be able to support the export industries, as well as we are still quite positive on the A-shares market, which notwithstanding all this, we are also expecting that there will be more stimulus measures, as well as probably some monetary policy easing measures coming soon. Starting from today, there will be an annual conference, annual NPC conference going on until next week, and from the conference itself, we will be hearing the official GDP growth target for this year, as well as some SOE reforms. So with that, I think probably for the next 2 weeks, we might be we might be hearing some updates on the reforms itself, and probably we would be able to see the market rally with hopes as well. Yep, hope that answered your question.
Hi, here's a quick one. This is Ken. I'll briefly talk about Valuetronics. So, some people are asking, hey, what's with Valuetronics today? I know there's some selling today, right? Okay, well, first of all, let me just say that on the fundamental side, right, there is actually no news at all. So everything is based on, so fundamentally there's actually no news. Company has not released anything. But what I do notice is that actually just a few days ago, last week, Valuetronics for the first time in 6 months, right, has finally hit overbought on the RSI for the very first time in 6 months. So I think this is just profit taking, okay? And so at the same time, if you look at the price now, price has recovered a little bit already after, basically a 1/3 retracement. So I would suggest waiting for the day to end to see what happens to the price. But 1 week profit taking, is not unheard of, especially with a move that has gone on since 35 cents onwards, right? Yeah. So anyway, no fundamental news, and we still think that Valuetronics is still cheap at this price, 40 to 42 cents. At this price, it's got such a cash hoard. PE x cash is still less than, it's like 4, and you're probably going to get a 7% dividend at this price.
Hello, this is Caroline. There is a question on will the NAV net asset value of cinema per share be only 56 cents right on the target price, and what is the foreign exchange risk going forward? This is okay for just to take note for the balance sheet on cinema lens. Their assets they are held at cost. They do not revalue accordingly like most of the real estate developers do. So like recently when they sold the New Brooks building, they actually recognize a gain of like 71 mil from the cost price, which is close to about over 40% gain on that. This is because they do not revalue the assets accordingly. So from what we feel is based on our revaluation, our NAV value, we think that we have taken into what is the probable price for their assets as per now. That's why there's such a difference in the target price as compared to the NAV. And for the exchange rate, foreign exchange risk going forward, of course, the main risk that likely to actually occur is because for, let's say, for BSD City, which is one of their subsidiary, is actually reported in IDL, and of course the for cinema, the profits or the financial statement are in sync, so there's actually some translation loss moving from IDL to SIM. But for one of the another of the big subsidiary, the Kota Delta Mas, all their sales are actually for industrial lands, which is this Kota Delta Mas is mainly selling of the industrial land sales, and for these are actually charged in USD. So I think personally there will be some like mitigation of the foreign exchange risk in this sense. Thanks. Hello. Is there any more questions? Hello. For cinema, they actually released the results. This is Caroline again. For cinemas, they actually released the result last Friday, and we have issued a report this morning. So you can actually refer to our report for any further updates on cinemas. Thanks. Hello. Since there is no further questions, that's all we have for today. Thanks for tuning in. See you guys next week. Bye.